Welcome to Trends with Benefits, a podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, investing, work, and life. Here's your host, Ed Lopez.
All right. Hi, everybody. We've done a few episodes on ESG and sustainable investing, and today we're going to continue that theme. This time on the fixed income side of things. I came across a stat from the Climate Bonds Initiative that I wanted to share that actually kind of just stood out to me, which kind of surprised me actually, kind of given what I think the perception is of the U.S. in terms of our leadership or lack thereof in the climate and anything ESG related. I was struck by a data point in this report that we'll talk a little bit about here that highlighted in terms of cumulative amount issued, the U.S. is the second largest source of green, social, and sustainable debt, with $276 billion issued through the first quarter of 2021. And the U.S. is the largest single country. You know, given the perception that we all have, or maybe many of us have about the U.S., and that might be the fact that the U.S. still lags the rest of the world in our efforts in climate change and the like. I wanted to dig into this a little bit. So I am grateful to be able to welcome my guest, Sean Kidney, CEO of Climate Bonds Initiative, which is an international NGO working to mobilize global capital for climate action. Sean, thanks for joining me today.
Thanks for having me, Lee.
You know, this report I was talking about, which is the state of the market report for North America, you guys just recently put it out in 2021. That data point that I read off, is that as interesting as I think it is?
Well, it's a bit like climate action globally. Yeah, the market is not acting, people aren't acting, there's not enough happening. But it doesn't mean nothing's happening. There is work underway all around the US. There are people doing things. There are organizations, institutions, and some state governments who are doing stuff. The US capital markets are big, right? It's the biggest capital market in the world, the biggest bond market in the world. So as a proportion, it's tiny, but it is there. We've had a lot of green bond and sustainable bond issuance, particularly in California, in New York, and a few smattering things in states between, from Virginia to Arkansas even. And then, of course, at the large corporate level, we've had a few notable big issuances. Apple, Google, and then a few utilities. So it's not as if things haven't been happening. It's been happening. Of course, perhaps most importantly, has been folks from overseas who've been issuing in the US market in US dollars. We've got a bunch of people, say, in Latin America, Brazilian issuers who've been coming to market with bonds issued in New York in US dollars to raise funds for investments in Brazil. So it's quite a heterogeneous story. There's actually quite a lot bubbling up. It's just that in the context of the main headlines you see, no one notices it. If you drill down to page 32, you'll read a lot about this sort of stuff in the Wall Street Journal or the New York Times, I think.
Do green bonds tend to be, or in this particular market, tend to be issued mostly in U.S. dollars or different currencies, or which currency tends to be most prevalent? I'd figure maybe euro probably gets a lot.
Yeah, look, euros are currently the larger one because over the last 2 years there's been a big upsurge in euro issuance. France issued 40 billion euros of green sovereign bonds, for example, and Germany, Italy, Netherlands, etc. have been doing the same sort of stuff. So it's pumped up the euro figures. 3 years ago, US dollar was the dominant currency. It's now euros, US dollars, and then renminbi, because it's quite a large and vibrant green bond market in China, thanks to a decision by the regulators and the central bank in 2014 to grow one. I'm going to say we had a little bit to do with that, but we'll put that aside for a minute.
I was going to ask about that. You had something to do with that, didn't you?
Well, look, I pitched the idea of green bonds and growing a green finance market as a useful central government means to push the economy green, because that's what they want to do for a long time. The challenge for them is how to shift things while they're focusing on economic growth and bringing people out of poverty, right? There's still 156 million people or something that by any world standards would be regarded as living in poverty in China. So there's work to be done. So they responded. This is in 2012, I think. I had my first meeting with People's Bank of China officials. I was a member of the People's Bank of China Green Finance Task Force in 2014. We published in 2015. But in the meantime, the central bank and a few of the other regulatory agencies picked up our recommendations, and there's been a flurry of activity around this sustainable finance agenda ever since. You've got provinces that are trialing guarantee schemes for green finance. You've got the central bank providing cheaper wholesale capital for banks, the liquid lending window, if they post green bonds as collateral. There's all sorts of stuff, lots of incentives being trialed to grow it. And the market has grown. Is it enough? No, of course it's not enough yet. We've got a long way to go yet. But I can't say that anywhere in the world is it enough. It's just that things are moving. We have a global market of green and sustainable bonds, which is about to hit $2 trillion outstanding. Nice. Of course, the global bond market is $110 trillion outstanding. So we've got a way to go yet, right?
So maybe we could take a step back and just talk about what are green bonds and maybe how you differentiate that from sustainability bonds and how long have they been around? How did they come about?
So the first green bond wasn't actually called a green bond. It was called a climate awareness bond, issued by the European Investment Bank in 2017, mainly to Nordic investors who were particularly keen on the idea. And the World Bank followed with a program of green bond issuance in 2018. And that lasted a few years. Look, for those bonds, it's a very simple idea. They're full faith and credit bonds. They're AAA. They pay the same coupon as other bonds. But the World Bank or the European Investment Bank promises to only use the proceeds for green or in climate-related investments. So think of this as you want to borrow money from your aunt to buy a car. And your aunt says, sure, I'll lend you the money, Ed. But you know what? I think you should just buy an electric car because it's better for the planet. And you say, sure, I'll buy an electric car. I wanted to buy one anyway. I will come back every year and take you for a drive at Christmas to show you I've still got the electric car. And your aunt says, great, here's the money. You're guaranteeing it yourself. Actually, that's a green bond. That's exactly what it is. And including the reporting on an annual basis. No more complicated than that.
And what types of projects do they tend to, have you seen or do they tend to support?
So when we started, the dominant area of investment was in relation to renewables. But as we've grown, renewables become a minority, still a fairly substantial chunk. They go to rail investments. That's low carbon transport, folks, in case you're wondering. There are electric vehicle bonds as well. There's a whole bunch of bonds around green buildings, energy efficient, emissions efficient buildings. And that will be big going forward because so many assets in the world are property assets. And we need to reduce the emissions level of the built environment really fast to achieve our climate targets. But we've also seen bonds for recycling companies, and they're high yield, by the way. There's all range of credit ratings in there and all ranges of tenors. We've seen bonds for agricultural investments, bonds for forestry investments. There's a whole lot of stuff here. It's quite big now. And then, of course, the social investments, I haven't even started talking about that. There's still a minority of the market. But the green market is about 1.4 trillion outstanding. So if you add it all together, we're about 1.9 trillion. It gives you a sense of scale.
And what do you figure the world needs in terms of investment in order to meet the climate targets?
Look, that's a good question, Ed. We at the Biden Climate Summit, we saw all the major economies make strong and necessary commitments to 2030 emission reductions. All of them could be a little bit stronger, but pretty strong. To achieve those targets, we're going to need a lot more capital flowing into the kinds of investments that are necessary to make the change, like renewable energy, like putting people into electric transport with an emphasis on rail, like a high-speed rail line between Washington, D.C. and New York. Now, wouldn't that be a good idea? And much twice as fast as Amtrak. All of these things need investing in to be able to get people out of polluting transport or whatever. We reckon globally, we need to see about 4.5 to 5 trillion a year of investments flowing into low carbon and sustainable investments. And the bond market is going to be probably about 30% of that. I mean, there's a bit of double counting that's got to happen before you finish, but that's the sort of scale. So when it took 4.5 to 5 trillion, that's the total investment. If you include equity, refinancing and bonds, and essentially the double counting that comes from multiple instruments around one assets, we'll end up having about 8 or 9 trillion of total volume. Bonds will be half of that, let's say. So we're going to have about 0.5 trillion issuance this year. That suggests about an 8-fold increase in the market before we can rest easy.
Do you believe that the burden to help support these projects falls more on governments or on businesses or individuals to help propel this?
It's not really individuals, except that individuals can help drive the change by investing in line with the kind of future they want to see created. Noting that in this sector, this is comparable risk and yield. You're not taking a haircut to save the planet. If there is a lower price, it's because they perform better in the secondary market. Either they're more valuable in a portfolio, which is what we're seeing at the moment, by the way. But it's a hard-headed decision. There's no sentiment saying, okay, well, it's just going to make me feel good. I'll accept an extra 100 basis points lower interest rate. That is not the case in this market. Individual investors have a role in driving change, in signaling, but the big work that's got to be done is by the larger institutions. I'll give you an example of two companies. About 15 years ago, BP had a renewable energy division. It had made a commitment to grow it. There was a change of CEO. The new CEO said, no, we'll just stick to oil. And then the Gulf of Mexico crisis happened and BP share price tanked, et cetera, et cetera, et cetera. They hadn't diversified. Another company at around the same time, there was a fossil fuel company in Denmark called Dong Energy, which ran Danish coal-fired power stations, also made a decision. Their decision was to become purely a wind energy company. Now, they still have a legacy small coal plant in their mix, but they're now one of the biggest wind energy developers globally. Early this year, the stock market capitalization of Ørsted, the wind energy company, overtook the stock market capitalization of BP. And that is the story of these times. That is the story of corporate leadership. And there's a lot that can be done in the corporate sector. But the same lesson applies to sovereigns. And we're seeing a rapid growth of sovereign issuance by countries that are taking action or as a way of recognizing what action they are taking. In this year, we will see the start of the European Commission's green bond program, which is a 225 billion program, billion euros, a AAA rated. And, and we've seen some junk yield rated from Egypt, which is about $700 million worth. So there's a whole lot of varieties of credit ratings in this area, but it's growing. The issuance is growing. But what's amazing about this is the investor appetite keeps growing at a pace. So we still see very strong demand around all of this. So that's good. But I still want our investor friends, our retail customers, your clients, to knock on the door of Van Eck and also to knock on the door of all the major pension funds they might have some money with and say, give me more green. That's what we could do.
Where is that demand that you're seeing? Is that coming from pension funds, the institutional investors?
It's largely institutional investors. Now, I'm not saying that there isn't a retail demand there. There's actually very little option for retail at this stage because most of the issuance has been for institutional investors, pension funds, insurance funds, bigger fund managers, the Black Rocks who are running funds for those clients, but also treasuries of banks. Central banks have got big exposures to green bonds. 20% of the European central bank's current quantitative easing program is green. So there's a lot of customers out there. The challenge of the retail has been a lack of opportunity to invest. And of course, that's why the ETF work that you're doing is so important, because it translates investment in the market into a means where retail investors can actually participate. I expect us to see many more opportunities. You're going to get some competition in the next few years, but you've got leadership advantage. But that's what we need, right? We need more opportunities for people to invest.
Need more awareness.
That's right.
I want to go back and ask about the sovereign aspect of things. There's not yet there's not yet a U.S. bond or U.S. green bond.
Oh, wish there was. But you know what? I'm optimistic. My hunch is 2022, we'll see a green T-bill. But it's only a hunch. I'm afraid I don't have any gossip from Treasury about this.
Yeah.
I do know.
Not breaking any news here. Okay.
No news. I do know that Treasury is very aggressive about wanting to meet the 2030 targets that the president has set out. Now, they then have to work out whether in the mix of things, kickstarting or a bigger corporate green bond market with some sovereign issuance will help. Generally, it does, right? Generally, bond markets need some liquidity injection from the sovereigns and some benchmark pricing, yield curve, etc., set by sovereigns. So our advice to most governments, and this is why governments are doing it all around the world, is to encourage the others, to get a corporate market going. And, I feel reasonably confident that the US Treasury will be having the same thinking at this stage. So I'm optimistic, but I don't have any actual gossip, I'm afraid. I wish I did.
When you're talking to the Chinese government and working with China in that regard, what do you think was the argument that was successful that perhaps sold them on the idea to support this area?
Well, there's a few things, really. They do have very strong environmental objectives. Look, essentially, they went through a process just like the US did in the 1880s and the 1890s of rapid economic development and rapid industrialization with vast environmental consequences. So the Chinese are trying to concertina 120 years of development that the US went through into 35 years. So it's a challenge. Now, they were very successful in growing very rapidly an industrial economy, an economy that has contributed great wealth to Chinese people. You wander around Shanghai and Shenzhen nowadays, and these cities are like New York now. Who would have thought that 40 years ago? Amazing. Of course, there's still a lot to be done in China, but the environmental cost has been pretty drastic. And these are people who have good education and understand the issues and are raising their kids in this environment. And they know that the water is often undrinkable. You better drink bottled water if you want to be safe. They know that the food is too often adulterated. And they know that the rivers flow red or purple or green too often. Now, they're also now becoming really aware of climate change. And, China is one of the most exposed countries in the world when it climate change. There's a hell of a lot of low-lying land around Shanghai. In fact, if you get 2 meters sea level rising, which frankly we're going to see by 2050 in my view, the whole of Shanghai is underwater. That's 20 million people, because it's like the Netherlands. It's there thanks to lots of dikes and canals to take the water away. And they have not built sea defenses like the Netherlands have to be able to deal with a storm surge. So they've got to do some work, and they're beginning to appreciate. And central government is pushing now hard on their climate targets. They've got reasonably robust targets for an economy that is the biggest polluter on the planet now. And that its coal fleet alone contributes 12% of global emissions. So they're doing their best. And that was one argument. But there were some other arguments to be run at the same time. We did talk about current account deficit. If we can use green finance to build more renewable energy, for example, that means less oil imports. China imports a lot of oil and a lot of coal. It likes the idea of not having to import stuff to the Straits of Malacca, because if ever the US declares war, it'll blockade all oil imports, has that power. So there's a geopolitical argument, which we use in every region, by the way, those kind of geopolitical arguments. And there was also an economic development argument where the government is acutely aware of the stimulus funding and what's worked and what hasn't done. One of the things China did, they read Keynes very well. And they understood that if you want to keep an economy afloat in crisis and keep people employed, very important when you've got 1.2 billion people floating around, you've got to stimulate stuff. So every time there's a hit of a crisis, they throw money at the problem. They throw credit at the problem. Unfortunately, in the West, we keep forgetting this lesson. In 2008 in Europe, we messed up. We forgot about stimulus. We said, oh, no, we just got to tighten our belt. And Europe suffered 10 years of crap growth as a result. But in China, the stimulus was kind of like, let every province spend and create some stuff. They created a lot of white elephants. Hey, we've created enough of our own white elephants in the US. We know the story. But this has been getting a bit repetitive. And the government knows that 15% of the money they blow in a stimulus is basically the equivalent of getting people to dig ditches and fill them up. At least the people are employed. But you've got a lot of Taj Mahal style provincial government centers, that sort of stuff. So the macroeconomists running the financial side of it want to have a way of having more effective and efficient stimulus without wasting 15% of the stimulus. They want to get down to a couple of percentage of wastage. And one of the things they know is that creditworthiness is important. If you have credit transparency, you're more likely to make a sensible decision. A bit of visibility, which of course we see now largely, not always, in the US market and the European market. And as a result, we have more efficient capital markets. So they're shifting the market in that direction. But they've got a problem because the Chinese economy has been built on the back of total implicit and explicit government guarantees. So most debt is 6-month term because it just keeps rolling over. Now, if you want to introduce a credit transparency, if you're not used to that in the economy, you're going to get capital flight every time it happens. That's scary, right? When you're trying to have a very stable economic growth. So they're thinking about how they can make this transition. They want to try and match the debt profile of the US market if they can build a more modern economy with better credit transparency. And we said to them was, there's something special about green. Investors love the long-term aspect of it. There's a big appetite for long-term debt. They thought, So not only do we address our climate stuff, maybe address current account deficit, but we also have a tool to try and start the slow shift towards long-term debt. And that's how we won the argument.
That's fantastic. For investors, what do they get out of this? I mean, and do they have a passion for the climate risk or dealing with climate change? Or is there just a straight numbers kind of investment case for investors to consider?
On one hand, I'm going to say, if you don't have a passion for addressing the greatest existential threat humanity's ever faced, I think you need your head read. But that is not what drives this market, just to be clear. That's a separate issue. I mean, I have a passion. I would say they wouldn't know because the science is pretty damn compelling. But from a market's perspective, this is a bog standard, very conservative, equivalent risk, equivalent yield product that has a bonus feature that the proceeds are used for investments material to addressing the Paris Agreement, both project and refinancing. A solar farm that was built 2 years ago is still material to addressing the Paris Agreement. So if you refinance that, that becomes a green bond. So that's the idea. It's a bonus feature. So if you think there is a potential, a possibility that climate change is a risk going forward, one of the ways you hedge your risk is you buy an instrument that is no different to the other instruments, but has a bonus feature that it also addresses that other risk that you've been uncertain about. Very simple idea. Highly scalable idea. Of course, once you get into the details of performance, what you are finding now is that green bonds are tending to outperform their peers in terms of value retention. Now, Larry Fink once said he didn't make money by giving his investors yield. I shouldn't be telling this for ETF that looks at retail investors, but that's what he said. He said he made money by ensuring his investors never lost their money. So capital retention is the first imperative of institutional investors when it comes to fixed income. And this has superior capital retention characteristics. Whenever there's a downturn in markets, green bonds hold their value. They keep trundling along like here, while other bonds go whoosh, whoosh. That's gold dust. Not to mention that, but in March of last year, when bond markets froze, I was getting investors who had green bond holdings telling me that green bonds remained liquid. They could continue to trade them. There was confidence in them. Now, boy, is that gold dust, right? So that drives the value. And when you're seeing value performance, it's on the back of those two characteristics.
Now, how does the CBI or Climate Bond Initiative come into play in this space here?
Well, look, we're a not-for-profit that focuses on the architecture of growth. Our interest is money going to the right place to address these big problems we have. I could talk for a long time about problems, the challenge we face. I won't. I'll just say, let's just park that for a minute. So our job is to encourage issuance, to support investors in assessment. We run a taxonomy scheme, which is green definitions, a certification scheme attached to it. So a bond issuer can get certification that the proceeds that they're applying the funds for are consistent with meeting the Paris Agreement goals, that sort of stuff. We work with central banks around the world on what policy might be, because they're very worried about future stability risk of climate change. They're looking at green bond programs as a risk mitigation effort. So we support them with that. And we work with governments. I've mentioned the Chinese government already, but for the last few years, I've been doing a lot of work with the European Commission on a regulated definitions called the taxonomy. Bad word for the US taxonomy, but that's what they called it. That's what they called it in Europe. And a whole bunch of policy initiatives they're pursuing around sustainable finance. So that's the sort of stuff we do. In Europe, we've been doing a lot of work recently. In the US, it's growing. We have a certification program. Fiona Ma, who's the state treasurer of California, sits on our Climate Bond Standards Board, for example. New York authorities like New York MTA has done a lot of green bonds, advertised on the subway even, that are certified climate bonds. But we need to grow that program. Things are moving in the US. The Biden administration's measures are creating a lot of investment opportunity. We want to make sure there's a good matching between the ones that are sustainable and this investor appetite from US and other investors. So you'll see us popping up more, supporting your work, Ed, in the US.
I was curious if you could tell me a little bit about why you established the CBI in 2009. What was the impetus? What got you to do that?
Well, Ed, I had a midlife crisis. What can I say? Well, first, my father died as I was approaching 50. And it took a while to die. I got told to turn up. I had to fly to New Zealand, where he was living at the time, and lit behind his bedroom in the hospital, and for a month before he finally died. And I grabbed a couple of things off my bookshelf because he was only compos mentis for about 6 hours a day, which is great, by the way. I got a chance to spend time with him, and he was a tough old coot. So it was. I got him at a vulnerable moment. I actually managed to get some proper conversation out of him in those few hours a day. But in the meantime, I read the books that I grabbed off the shelf. One of the books, for some crazy reason, I took was the Proceedings of the Exeter University Conference on Catastrophic Climate Change, chaired by Tony Blair, the Prime Minister of the UK. Sounds good, but it sounds a bit dense. Boy, was it dense. Series of technical scientific papers. But I'm going to say I got to the end of each paper, sitting alone in my room at night in a dark hospital. And I kept thinking, yikes, this is like really bad. Let me reread that. I can't be right. Then I'd reread it and I'd think, it is bad. And every paper was like that. And whilst I'd known a bit about climate change, I'd done work in environmental sectors, it was a bit of a wake-up call. And it made me realize this is actually existential threat. If you believe the science, and why wouldn't I believe the science? The whole economy is based on science. If we didn't have science, we'd still be living in mud huts somewhere. So it's created. So you've got to take this, you've got to treat this thing with respect. And here I was, multiple different authors, multiple different scientists, and of course I started reading from other places. It was a shock. I got back to Sydney, where I was living at the time. One of my businesses ran into problems. That was a bit terrifying. We had a tough time. That shook me up, shook my confidence. But it also made me realize, I was probably stale. That's why it happened. I needed a bit of a change. What was I going to do again? What did I want to do when I was young, when I figured out what to do with my life? That was the other thing that happened. And then I had a stroke. Coup de grace, what they call a mini stroke. So I ended up in hospital for a week. And that really makes you think, well, so what did I want to do again of my life? I guess I better figure it out. I could die any minute. and all of these things that came together. Now, in my case, instead of going out and buying a red Maserati, I decided I wanted to do something different with my life. And I've got 4 daughters. And I started thinking, what sort of world am I leaving them? What can I do? So I spent a couple of years, in fact, researching what I might be able to do. And I'd done a lot of work with pension funds and so on in Australia and in Europe. And my view was, these guys have got long-term mandates. They need to look 20 and 30 years into the future, whereas other people are getting more and more short-term focused, notably corporate executives in the US, who'd started to look at just to the period when they could vest their shares and not beyond. So in that context, I thought there was a chance of achieving change if we could bring the money to the table as a force for change. And that led me to setting up the Climate Bonds Initiative. In fact, moving my family to London to work on this as a global project. And they were kind enough to indulge me for a while until I was able to prove it would work. And here we are, about 12 years later, with a nearly $2 trillion market.
Going back to sustainable debt and green bonds, the outlook that you see for the space and the growth, what do you think are the driving factors today?
Well, we've got a few big factors. I mean, the most important factor, given the story I've just told you, is that institutional investors are acutely aware now of the long-term risks they face from the impacts of climate change on their portfolios. The Institute of Actuaries in the United Kingdom a few years ago put out a report about climate change, which essentially said wholesale portfolio decimation by 2050 for pension fund and insurance fund investors, based on the extreme volatility they expected to become the norm on current trajectories of climate change. And so you suddenly got a whole lot of people saying about that. What do we have to do to change things? Now, there's only so much an insurance fund or pension fund can do. You've got a mandate, you've got to achieve it. But we started the conversation going. And that led to significantly increased demand for the kinds of investment products we're talking about. And that is growing because more and more people are coming to do it. We've now got an opportunity side that's come to the mixture. Over the last few years, we've seen the impacts of policy changes. When Germany started a feed-in tariff that drove down the price of solar. China did the same a few years later. We now have dirt cheap solar as a result all around the world. Whoa, governments taking action leads to real change. So investors are now twigging, okay, I've got a risk, I might miss out on change, like the Ørsted BP story. If you as an investor had invested in Ørsted, you would have been a lot better off than investing in BP in the last 10 years. So they're looking for how they can get ahead of this curve and get ahead of this policy change. And so again, the green bonds represents the universe. And those companies that are issuing green bonds, essentially signaling we have a green transition strategy, and that makes it very attractive. In fact, in Europe, you see a stock price bounce when a company issues a green bond as a result of that recognition. But we've got other stuff happening too. We've got over 90 central banks joining the network for greening the financial system, looking at climate risk and at opportunities to address it, including the US Fed. Whoa, that is signaling, right? So now every investor and every bank is thinking about this. And then finally, you've got the Biden Climate Summit, every major economy committing to strong 2030 targets. It's a reasonable idea to think, a lot's going to happen these 10 years. We better get ahead of this curve and see how we can make money off it. And that includes green bonds.
I was going to ask you about the report that you guys recently put out on North America and kind of the state of play there. What was your major takeaway from that report and what's going on in North America today?
Look, I think the main thing is actually there's a lot going on and people have missed it a lot of the time. We see a lot of bond issues. You read out the figures earlier on in this interview. So there's actually a lot of opportunity to invest and it's going to grow and it is growing quite fast. We think it's going to grow very fast in the next 2 years, but it's already substantial. And of course, we already have opportunity to invest like the VanEck ETF, which people often don't know about because the word hasn't spread. It's time to spread the word. And that's why we did the report, really, to highlight what was happening and to highlight the opportunities, to highlight the investor demand, to highlight what governments could do to grow it for no cost most of the time, or for like issuing a UST bill, where the Treasury will get a benefit, but it will also help grow awareness and grow the market and grow capital flows. So there's so much we can do. And that's why I put out the report. And I have to say, it's been great. We've had a really good, strong response to the report, helped by the fact there's been a few landmark issuances recently. Stanford University did a certified climate bond recently. They had a fantastic result. And since then, we've been getting calls from universities saying, tell us more, tell us more, tell us more. In each sector, it's a bit like that.
That's great. Do you think news and headlines kind of like the fires on the West Coast and the floods in Europe and Germany, a lot of people are attributing that to climate change, will spur more demand?
Look, you saw 117-degree temperatures in British Columbia. That's pretty damned amazing, right? So, of course, that's part of it. I think people are wondering, you see chatter, it's not climate change that happens. It does happen. It's true. The heat incidences that we've seen in the Northwest in the last few weeks are, according to the scientists I speak to, 1 in 200,000-year events. But they're also saying they're going to become 1 in 20-year events very, very quickly. That's the scale, gives you a sense of the extent of change. So volatility does happen. What we're talking about is volatility being compressed and happening more frequently, and the background temperatures rising quite rapidly. So yeah, I think it does have an impact. The fires we're currently experiencing in Northern California. And how many years have we had these incredible fires in California? We've had them year after year for years. This is not normal. Not to mention the floods in Europe and what we don't hear about is emerging market impacts because they tend not to make the news. We had incredibly bad floods in Bangladesh, worst floods in history last year. So just last year. And this is the story happening around the world at the moment.
And so there will be more demand for this type of investment to mitigate some of the climate impact. And from an investor standpoint, something to consider and look out for.
Absolutely right. As awareness grows, of course, the opportunity to invest will also grow. But remember, the way we're structuring this, and I say we broadly, the market, is equivalent risk and yield. If there's a pricing benefit, it's because of a value difference. It's not because of a sentiment. And let's face it, we've got to be realistic about what's going to change quickly. We're not going to change quickly by asking everyone, like we might do in a war, pull your belt in and eat less. That's not going to work. We've got to make it work as a financial proposition at the same time. And that's what we're doing.
So what's one long-term trend you see playing out over the next year or several years?
Well, there's trends in the green finance market. The first thing is a multiplicity of offerings and instruments. We've seen a variety of green debt, including we've got green repo loans going on now and green commercial paper, would you believe? We're seeing a whole sustainable loan market, which is binary loans between a bank and a lender, which they market as green or sustainable and get independent review and all these things. So that's actually very positive. And that market is huge in some places. We're seeing green equity. Goldman Sachs announced a couple of weeks ago that they're going to launch a green equity program. I haven't seen the details of what they intend there, but it's interesting. And you can see they're going to make sure that equity is allocated to parts of the business that are specifically related to being green. And there's a few banks around the world. You're going to see green retail products. Very soon you'll see a green credit card. And what will that mean? Well, there's a few options. There's a few discussions underway. Ant Financial, the offshoot of Alibaba in China, has done. In their payments interface, they've got an app, basically, it's just your phone. You can choose to enroll in a carbon counter. Every time you buy something, and nearly everyone uses Ant Financial to pay for things called Alipay in China, it tracks up the carbon. And you can then swap the carbon for goods, virtual goods or real goods, or you can cash it in and they'll plant a tree for you. In the first 3 months when they rolled this thing out, they thought they'd get a few million people signing up. They got 200 million people signed up. And nowadays they have like 500 million people enrolled in this. So now it's a small step to say, well, why can't that work on a credit card? Where every time I buy a purchase, it tallies up the carbon footprint, and then I can redeem the points to plant a tree in Northern California where they've been burnt out. Well, actually, you're going to see that quite soon. There's a few banks working on those sorts of things. So there's a bunch of things coming through, which are all extensions of the same idea.
Do you want to try playing Trend or Fad, our speed round?
Oh, Ed, you scared me when you told me you were going to do this, but give it a shot. I'll give it a go.
All right, let's go. Brand activism, Trend or Fad?
Trend. I mean, just based on history.
Ethical investing, Trend or Fad?
Trend, because the opportunity is now available to us. We can exercise. In the past, we couldn't.
Standing desks, Trend or Fad?
Trend, because I want one. I've got to get one.
Get one. I have one. It's nice to be able to stand every now and then. All right. And last one, hybrid work weeks, Trend or Fad?
Well, clearly trend. I mean, can anyone imagine going back to being in the office 5 days a week all the time? If you've got a choice, that is. Some people don't have a choice. But if you've got a choice where you're working at a computer, why wouldn't you? And by the way, for the employers, it's going to save money. We discovered that people don't slack off. They don't go off and play football or frisbee. They actually work.
That's true.
That's the lesson from the last year. So that's a trend.
Well, this has been great, Sean. I really appreciate your time and your insights. I thought it was fascinating. What's the best way for people to follow you or learn about what Climate Bonds Initiative is doing?
We publish a US Green Bonds newsletter. If you go to climateandcapital.com, you can subscribe to it, or else you can subscribe to our announcements list at the climatebonds.net website. The newsletter is pretty good in the US because we try and distill every fortnight what's happened around the world relevant to the US market. So that's probably the place to look first. climateandcapital.com.
And for the report that I referenced in today's episode, I'll drop a link on our own blog, a link back to your website as well so people can find it.
That's right. If you go to our website, climatebonds.net, you'll find it.
Well, thank you, Sean.
As you can see, it's getting dark where I am. I'm in London at the moment.
Yeah.
So I forgot to set up my lights. My apologies for my darkness. But thank you so much for being able to include me in your show.
And thank you for joining. I know it's dinner time, so enjoy the rest of your evening.
Thanks, Ed. See you later.
And thank you for tuning in to another episode of Trends with Benefits.